Buckle up, folks. Mortgage rates are surging across America, and this is going to inevitably crash the U.S. housing market and lead to big price reductions across certain cities in America in 2022. Certain areas are absolutely in the crosshairs of this mortgage rate surge, which is much higher than I thought it would be. I just did a 2022 housing market prediction video, and in that video, I talked about how we're going to see higher mortgage rates at the end of 2022. However, I was not prepared for just how fast mortgage rates were going to go up, particularly over the last week, where we have seen a record historic increase in mortgage rates. In just a couple days, the affordability of owning a home has tanked due to higher mortgage rates. And as I said, this is going to be big problems for certain cities, certain housing markets across America. So here's what I'm going to do for you all, you potential home buyers and real estate investors. In this video, I'm going to do three things. Number one, I'm going to show you just how much mortgage rates have gone up over the last week, just how much this historic surge has eroded homeownership affordability. Number two, I'm going to show you the cities that are most at risk of a crash from these spiking mortgage rates, as well as the cities that are more protected from a crash during the rising mortgage rate environment. Because if you're a home buyer, real estate investor, you need to understand the difference between these type of housing markets. And then number three, as a bonus, I'm going to explain to all of you home buyers and real estate investors out there why higher mortgage rates could actually lead to lower mortgage payments in the long run. That's right. Higher rates could lead to lower payments. I'm going to show you exactly how that's going to work at the end of the video, so stick around for that. All right, everyone, without further ado, let's get into the data. And I'm going to get things started by showing you all just how much mortgage rates have surged over the last couple weeks and last couple months. And let me tell you all, this is historic. If we take a look at data from Mortgage News Daily, the prevailing 30-year fixed mortgage rate is 3.5% in America right now. And just take a look at this massive run-up that's occurred just over the last 2 weeks since Christmas. Folks, around Christmas, the mortgage rate was 3.16%. Now it's 3.5%, which means a massive erosion of affordability for homeowners who are going to buy a home. Your payments are going way up. Additionally, if we go back only 3 or 4 months, we can see the 30-year fixed mortgage rate was like 2.9% in late August. Now it's 3.5%, and it's going to continue hiking upwards over the next couple months, over the next year. And these higher mortgage rates, particularly rapidly spiking mortgage rates, are very damaging to the U.S. housing market and U.S. home prices for two reasons. Number one, when you jack up the mortgage rate from 3 to 3.5% in only a couple months, that means that the cost of home ownership surges. You can bet that wages aren't even close to keeping up with that, which means that fewer and fewer people can afford to buy a home or qualified to buy a home. Number two, the record high nominal and inflation adjusted home prices we're seeing in America, that's right, home prices are at a record high right now, adjusted for inflation, means that the down payments required to buy a home are extraordinarily high. And so when you combine those higher down payments, number two, with the rapidly spiking mortgage rates and mortgage payments, that means big problems for the U.S. housing market, big price declines, specifically in certain cities. And you can see on this map, the 300 largest housing markets in America, the places that are most at risk from this mortgage rate spike. The places in red are really areas you need to be concerned. Let's start off with Austin, Texas, where the typical annual mortgage payment in Austin, based on a 3.4% mortgage rate, is $26,000. That compares to only $57,000, which is what the average worker in Austin makes. And so that means that if the average worker in Austin wants to buy a home, that mortgage payment is going to occupy 46% of their earnings, which is extremely high, which means that people in Austin cannot afford to buy homes at today's prices and mortgage rates. And if we head west, we can see that this story is consistent through much of the mountain and west coast regions of America. In a place like Denver, the typical mortgage payment is 47% of worker earnings. In Reno, Nevada, it's 56%. In LA, it's 67%, folks. In LA, 67% of worker earnings would go towards the mortgage payment. In a place like Seattle, it's 49%. But where things get really problematic for these markets in red is when the 30-year fixed mortgage rate goes up more. Say it goes from 3.4 to 4%, which in my 2022 housing market prediction video, I said 4% 30-year fixed mortgage rates by the end of 2022. I actually wasn't prepared for what was going to happen in the week after I put that video out. I might have to revise my projection. I actually talked to someone in the mortgage industry who thinks we could see 4% by March or April and 4.5% by the end of the year. So if we see 4.5% by the end of the year, Austin crashing, Seattle crashing, Salt Lake crashing, LA crashing, any market where homeowner affordability is stretched is going to go down. Meanwhile, the areas in the markets in blue on this map are much more equipped to handle this increase in mortgage rates and aren't necessarily going to crash. For instance, a place like Pittsburgh, the typical mortgage payment is only 20% of what the average worker makes. And so what that means is that for the average worker in Pittsburgh to afford or qualify for a loan, there's a buffer there where mortgage rates can go up and maybe that payment ratio goes to 25%, which is still kind of reasonable. It's not going to nuke the housing market in Pittsburgh. Quick 5-second commercial, everyone. If you guys like this data and you want to see more of it going forward, just smash that like button. Same thing in a place like Birmingham, Alabama. The typical mortgage payment is only 20% of what the average worker makes. So prices in Birmingham aren't likely to go down by as much in a higher mortgage rate environment. The same goes for Chicago, believe it or not. Chicago, the typical mortgage payment is only 24% of what the average worker makes. And so that's some wild data, folks. The massive differences that exist in home ownership affordability and mortgage payments compared to worker wages across America. You can see very clearly it's not all of America that's in a massive housing bubble. It's specific markets, primarily on the West Coast and mountain regions, as well as some parts of Texas that are in a big bubble and are gonna have a big crash. Meanwhile, areas in the Midwest, maybe not so much. Areas in the Deep South, maybe not so much. And just to really drive this point home, I'm gonna do a rapid fire round right now, folks. I haven't done a rapid fire around in a long time. I'm going to take a look in the next 2 minutes at 10 different housing markets across America and how their affordability in terms of mortgage payments to wages has changed over the last 15 years. And this is going to be some wild data so you can understand better if your market is at risk of a crash or if your market is safe from a crash. And so what we're looking at on this graph is comparing Austin, Texas to Chicago, and again, that ratio of mortgage payments to wages over the last 15 years, going back to the peak of the previous housing bubble in 07. And so what do you see with Chicago is that back in 07, mortgage payments were 42% of the worker wages in Chicago, and Chicago had a pretty big housing crash, and you can see the mortgage payments went down by a lot. Now today, the typical mortgage payment in Chicago is 24% of worker wages. So we're actually in a much better situation in Chicago today for affordability than we were in 07. But Austin is on the exact other end of the spectrum. The payment ratio in Austin's 46% today, compared to 37% at the peak of the last housing bubble. So Austin, way more expensive than it was at the peak of the last bubble. Chicago, way cheaper in terms of workers being able to afford mortgage payments. How about comparing Phoenix to Pittsburgh? In Phoenix, we can see that the average payment ratio is 38% towards the end of 2021, which is much better than it was at the peak of the last bubble. At the peak of the last bubble in Phoenix, it was like 53, 54%. So that means owning a home in Phoenix is more affordable today than it was back then. However, we can see this rapidly escalating ratio is concerning, and I think Phoenix is at risk of a crash. Maybe it's not going to have the 50% housing crash it did in the last bubble, but I think 25% to get this payment ratio down to around a 30% range is realistic. Meanwhile, we can see that Pittsburgh has just been steady Eddie pretty much this whole time. The mortgage payment ratio has stayed in a band of around 15 to 20%. And so, as I said before, unlikely Pittsburgh has a big crash. Take a look at the difference between Denver and Washington, D.C. Today, the payment ratio in Denver is 47% compared to 37% in D.C. Both of these are elevated, but what I really want you to focus on is the change over time. DC's 37% payment ratio today is actually much lower than the 60% it experienced in the 07 bubble. And so what this means is that homeownership affordability in DC is much better than it was in the previous bubble. And you can see it's actually stayed around this 37% range for pretty much the last 7 to 8 years, meaning that the home ownership affordability in DC has been stable, unlikely that there's a big crash. Denver, on the other hand, is the exact opposite situation. The payment ratio spiked to 47%, which is above what it was at the peak of the last housing bubble. So Denver's gonna have problems going forward, particularly as mortgage rates continue to go up. How about Seattle versus Columbus? Take a look at this, folks. In Seattle, the payment ratio is up to 49%, which is nearing the highs that Seattle experienced in 07. So the Seattle housing market right now is in as big of a bubble as it was in 2007, when home prices then declined by about 35% in that crash. So I think Seattle's in a big bubble. Columbus, not so much. The payment ratio in Columbus is 27%, maybe a bit above what it was over the last 4 or 5 years, but we can see it's actually below where it was in the previous bubble when Columbus didn't even really crash that much. So I think Columbus might have some downside, but not nearly as much as Seattle, and you can see why on this graph with the payment ratios. Finally, let's take a look at San Jose versus New York. This is a very interesting comparison. If we go back to 07, we can see see that both of these markets were in big bubbles in '07. The payment ratio in San Jose was around 88%. In New York, it was around 70%. Then they both had a crash. They both were similar affordability in 2012. But the big difference since then is that affordability in New York has basically stayed in this 45% payment ratio range for the last 8 years, which means that the increases in wages in New York have matched the increases in mortgage payments, whereas in San Jose, we are back to another ridiculous level. 85% of worker wages are going to mortgage payments. Now, as I said to you in the beginning, as I teased in the beginning, folks, one thing you all need to understand is that while rising mortgage rates will mean higher payments in the short term, that does not necessarily mean higher payments in the long term. And this is really an important thing to understand because I know right now there's a lot of realtors out there who are going to be trying to scare their clients into buying based on the rising mortgage rate environment. A lot of realtors are going to say you need to buy now to lock in your low monthly mortgage payment because rates are going to go up and your payment's going to go up. But that's not necessarily true. And in fact, rising mortgage rates could mean lower mortgage payments in the long run. And let me show you why that's the case. Take a look at this sensitivity table, folks. There's two variables we're comparing. One is the 30-year fixed mortgage rate. One is the potential decline in values of U.S. real estate. And what we're then looking at is how much your mortgage payment would go up or down based on the intersection of these two variables. So let's just start with, mortgage rates going to 4%. Mortgage rates going to 4% from where they are today would lead to an 11% increase over the prevailing mortgage payment in November and December for homeowners in America. So yeah, if prices stay the same and mortgage rates go up to 4%, that would definitely increase your mortgage payment. However, if the mortgage rate went to 4%, but then values decline by 15%, that would actually mean that your mortgage payment goes down due to the lower price and loan amount that you would need to take out to buy a house. What about if the mortgage rate goes to 4.5%? Well, yes, if prices stay the same, you're going to have a big increase in what you pay on your monthly payment. However, if values go down by 20%, you would actually have a decrease in your monthly payment at a 4.5% mortgage rate. And so it's very important for you all to remember that as a home buyer or real estate investor is that higher mortgage rates, while in the short term, before prices have a chance to react and go down, yes, it will mean higher mortgage payments, but inevitably when prices do go down, that's going to push the mortgage payment back down. So higher rates do not necessarily mean higher mortgage payments, particularly in the markets in red on the map we talked about before. I think higher mortgage rates are actually going to lead to lower payments in these markets in the future because prices are going to crash by quite a bit. All right, everyone, I hope you enjoyed this video. I tried to give you as much data as possible on what's going on right now with mortgage rates in the city it affects and what that means for future payments as a home buyer or real estate investor. If you appreciated this data and you want to see more of it going forward, just make sure to smash that like button. Also, please leave a comment. Let me know what you think of this video. Do you agree with me? Do you disagree with me? Do you have any questions about the data? Please leave a comment below. I'll be happy to respond and answer to any questions you have. In addition, please make sure you're a subscriber of this channel. I come out with 3 data-driven videos per week. You're not going to want to miss this content going forward with the rapid changes that we're seeing in the housing market. Like, folks, mortgage rates went from 3.2 to 3.5% in basically 2 or 3 weeks. You need to be on top of this. You need to be tracking it. Additionally, if you're someone who wants more data about your housing market, particularly the affordability in your housing market, some of the data we looked at today on home prices and mortgage payments relative to wages, you might want to become a channel member. Hit the join button below. That's going to give you additional benefits as a channel member, particularly access to my monthly newsletter, which is 50 pages long and has all the data you could imagine on the US housing market, so you can understand how exposed your city is to a crash or how resilient your city is going to be from a crash. It's all in this newsletter, as well as exclusive videos that I put out for channel members. So if you're interested in that, if you're kind of a data nerd, you want more information, hit the join button below, become a member. There's also a link in the description. All right, everyone, until next time, this is Nick from Reventure Consulting, signing off.